Hey guys, welcome back to the Educated Homebuyer. This is where myself, Jeb Smith, and Mr. Josh Lewis, our certified mortgage professional here, answer your questions live on mortgage and real estate to help you become more educated homebuyers. So welcome back to the show once again. Since last week, we've had, the most important news come out today, which is the Fed, and they did exactly as we had expected. Josh, my phone is ringing mid thing here. So they listened to us finally. We said hike 25 basis points again, and they did it. And with that, the bond market reacted accordingly. Nothing crazy there, and it's because we anticipated this, right? We've been talking about it the last couple of weeks. This is what we expected to happen at this time. Ask us a year ago, we wouldn't have expected this, but we expected it this time. And with that, we're going to talk a little bit about inflation. But before we do, Josh, welcome. You had a trip last week. You were gone.
I did. I went to the lovely state of Idaho. I had a nice 2.5 days. I got to hang out with my grandma. I got to see my mother. I got to see my nephew. Unfortunately, it was for a funeral, so it wasn't all good times. But rest in peace. My stepfather has gone on to heaven, and here we are back in California.
All right. So with that, condolences there. We've already said them, but just to make sure the public knows that I do have somewhat of a heart, and wanted to mention that. So let's take a look here, Josh, and start with the news of the day, right? It has to do with the Fed, it has to do with inflation, and then we'll do, as we always do, we'll look at inventory, we'll look at what's happening in housing currently, and then we'll start answering some questions for you guys. So start filling that chat up with your questions so that we can get to them and really nail down some stuff as we dive in. So Josh, first thing here, let's talk about highlights. And as you do that, I'm going to put the link in for all of these slides into the description so that you guys have them.
Perfect. So as you mentioned, the reason why we really want to look at these highlights, this is the bulk of what the market was looking for from the meeting. Everyone knew what we had a 96% chance of getting this quarter point hike. Market had priced it in. The only way he could have moved the market is by shocking with the comments here, by not cutting or by not hiking, by hiking 0.5%, something other than the 96% chance that they were going to do what they did, which was a 0.25% hike. So what he said in the presser was June CPI was welcome, but it's only one report and only 1 month's data in that report. We will be looking to see if the signal from the June CPI is replicated. So we talk about, they look at PCE, they look at producer price indexes, they look at a number of things. So they want to see multiple months, they want to see multiple reports. Core inflation is still pretty elevated. So the takeaway there is they are looking at year-over-year data. They don't care about month-over-month. The month-over-month data for 3 to 6 months has been very positive that inflation is in the range that they want to see. They're saying we don't care. We want to look at the year-over-year. They're saying we will make decisions meeting by meeting. So earlier in the year, every meeting, they made it pretty obvious, hey, we're going to hike again, and then probably again after that, and possibly again after that. They're saying we are now to the point where they'll make decisions meeting by meeting. If data suggests more hikes are needed, that's the judgment we'll make. So they're warning you they could hike again, but it's going to be data dependent. September raise possible, no raise also possible. So just really saying we are truly data dependent, going to watch what is happening with the coming reports. It's important that they believe they have reached a point where monetary policy is restrictive. Even as recently as the last 2 months, we've seen Fed members out in their public press conferences saying things where they think they're not properly restrictive or not restrictive at all. This is the head man in charge saying that he believes that policy is restrictive and the committee believes that policy is restrictive. It makes all the sense in the world to slow down. So you notice he didn't say it makes all the sense in the world to stop. It says to slow down. They need to hold rates high for some time. Currently, the Fed funds futures market is predicting cuts for the first quarter of next year. So technically, that is some time. We're in July. That's another whole half of a year before we would see coming off of these levels. So Jeb, did you want to go through the real estate data, or you want to kind of look at this?
Let's just look at inflation, and then we'll start talking about real estate.
So this here is an interesting chart. The Atlanta Fed, each of the regional Feds, they do research. They're academics. They're not out in the real world, so we got to take their research with a grain of salt. But the Atlanta Fed, in addition to their GDP Now index, they have what they call their sticky core CPI ex shelter 3 months annualized. And if you look at that, we are well below what the Fed targets, which is 2% annual inflation. And again, for any of you watching and screaming, no, inflation is still way too high. We're not talking about prices. Prices are a level. Inflation is a rate. The increases of prices has moderated back to the level that the Fed would like to see. So this gives you a breakdown of year over year and month over month of core PCE. And if you look, we are in here at that dashed line. So if we're at 0.25-ish, that says 3% annual inflation. We know the Fed's looking for 2%. From there forward is the Goldman Sachs forecast. They are absolutely predicting that we're going to be at or below 0.2% on a month over month basis, which puts us somewhere between 2.4% year over year. So everything there is moderating in the way that we would like to see. If you want to see the breakdown there, the cool thing on the chart, you see things that are starting to go negative, new and used cars, housing we've been talking about for the better part of 6-8 months, that those numbers are trending down. Core services is trending down for whatever reason. Goldman predicts that towards the end of 2024, it'll tick back up again. But again, Jeff, just showing inflation absolutely moderating despite the Fed saying, hey, one report, and we have 1 month of that one report. This here showing that the U.S. is not alone. These are US PCE, US CPI, Euro area, UK, Canada, Japan. Look at the chart. Doesn't take a genius to see that those levels were all too high, number one, and all moderating back down to what's expected. This just shows what governments around the world are doing. September of last year, 34 different central banks around the world hiked. In July, we had 4. So we're getting close to the point where all the central banks are backing out. So the question just becomes, how long do they stay at those elevated levels, and when do cuts come along? This, Jeb, is a little bit of a different chart. We've shown this 1,000 times. That green line is what we always talked about, that we were in a 40-year bull market for interest rates. Interest rates over a 2-3 year period got nothing but better for the better part of 40 years. You see that bottomed out during COVID and has gone red line straight up there. So everyone is keen to say that 40-year bull market is over. The trend has been broken. Rates are going to go higher. We're in a new normal. So on the next chart here, this is the real yield on 10 years. And what you'll notice is that 40-year downtrend has not been broken. Now, it's important to not read too much into this. What is a real yield? It's the actual yield minus the level of inflation. So when you back out inflation, what you're seeing is over the last 40 years, the yield that investors and treasuries get has decreased. So if and when inflation normalizes, you would have this trend still intact. So people ask, hey, are we ever going to see a 3% interest rate again? Is it ever going to go lower than that? There is a lower bound, and there also is a limit to the benefit of lower interest rates. Going from 6% to 4% gives you a much bigger benefit than going from 3% to 2%, even though it's the same 33% improvement in rates. So that came up this week. I thought it was important. You guys asked last week, is the spread between treasuries and mortgages is 3% the new normal or even higher? Is that what we're going to see? So we've talked about going back to 1980. The Fed has the data going back to 1971. So you see it has spiked to 5 and 6% at certain points in the past. But that chart shows you the high end for the majority of the time for the last 52 years has been 2.2. The low end of that is 1.1, 1.2, and the majority of that time has been incredibly consistent, right in that 1.5 to 1.75 range. So could we see a new normal that's closer to 2%? Absolutely, but I don't think anything has much changed. This one I wanted to throw in there, Jeb. It's not related to inflation, but it does give you an explanation for why we saw the market pick up in the spring, and we've seen more demand than what people think. So real earnings are a critical determinant of the decision to buy a home. So we saw when inflation spiked, even though wages were going up, they were not keeping pace with inflation. So you had real income decreasing. When that turned around, inflation came down and wage gains went up. We saw more people step into the market. So an explanation for possibly why we've seen a more resilient housing market than was expected.
No, good stuff. And so anybody listening on the podcast, watching right now, YouTube, the link for all of these slides is in the description. Just go check it out. It'll be there. You can, it's actually in Google Drive. You can download them. You can do whatever you want to with them there. But the information is there if you want to see it in more detail. With that said, Josh, let's talk about inventory. We talk about it every single week. So this past week, we saw a little bit of an increase in the number of properties on the market. I think nationwide, we saw 8,000 or so. We're going to take a look at the week over week stats here in just a minute. Orange County, 2,331 homes. That's less than last week. Huntington Beach, 178, less than last week. In fact, what we're doing is we're taking a chart and we're going to start creating our own little data slides here, just showing you the graphs of inventory, because we talk about it every week. I think it's good to bring on our own little graph here just to kind of provide some context. We're probably a week out from having it ready, because we got to go back and get some of the data that we've been talking about. But nevertheless, it will be here soon enough. So inventory, again, it's a closer look at this chart here, just a little bit more dialed in, looking at the last 3 years. You can see we're still trending under 2022. Inventory going up a little bit, tends to head up, towards this time of the year, and it peaks probably within the next 3 to 4 weeks is what we're likely to see, which means from that point forward, inventory should likely come back down unless you were to see rates go way down, which I don't think is going to happen. This is more of a historical looking chart, although, the last 8-9 years isn't historical to some degree, but just shows you trends in inventory, where we were prior to the pandemic, what more normal looks like. Again, we look at it every week. I like to see it here. The reason we saw inventory pick up a little bit more this past week than we have in previous weeks is because we saw a little tick up in new listings, right? New listings have been lagging. Inventory has been staying low. Last week, we saw a little bit of pop in that, but we're still below 2022, 2021 levels with inventory out there. That is the reason housing is a problem. There's not enough new listings coming to the market. And we've talked about that. But weekly change, we saw it go from 470 to 479. So just over, just under 9,000 listings there, 8,800 and something. Same week last year, we went from 508 to 525. So that's about 16,000 listings during that period of time. So double last year, we doubled what we did this year. Inventory bottom for 2022 was 240,000. The peak for this year, we've got more inventory on the market this time right now this year than we've had any time previously during 2023, right? We started the year at 472. We're sitting at 479 now. So we finally got back over that hump of where we started. Context, back in 2015 or 2015. That's like a long time from now. 2015, active listings, we were sitting at 1,202,000. So considerably higher than where we are today. Again, what's that?
It's almost incomprehensible how big that difference
is. It's what? I mean, not 3 times, but hell, 2.5 times more. You can see at this chart here, this is, pending contracts versus new contracts coming in. If you look back this time last year, you start to see, right, the number of contracts go down, right? That's likely what you're going to see this year too. Seasonality playing in. You got 10% fewer this year than you did last year. New contracts, 5% fewer. It's seasonality. It's going to start playing in the market. You're going to have less transactions taking place, along with, affordability being a problem. It's just going to exacerbate it. So sales price each week are higher than they were last year. So currently sitting at $379,950. Median home price currently sitting at $450. Last year this time, $450. So we're more or less in line with where we were last time. So we've all talked about it. Prices haven't crashed. Percentage of properties with price reductions, 33.7%. Again, this seems to be the trend during this period of time, right? The number of homes doing price reductions is going up, and it's represented in that chart going back prior to the pandemic. You kind of see the same thing happening. This is a cool chart that I saw of existing home sales that I thought was interesting. Just kind of shows you context of where we sit historically versus, last year this time, or even back during the pandemic, or, back during the housing bubble, if you will. Just less transactions out there taking place in the market. But you can even see back when it was complete mayhem, like hell in the market, you still had, 3.7 million transactions taking place, Josh. So people are still buying homes in a time of full distress in the market. And now we don't have that distress per se, but, transactions are still there. And I think that was it. Yep. All right. Cool. So with that, time to answer your questions. Time to answer your questions. We've got about 45 minutes. I do want to throw out the podcast that we put out on Tuesday. It's on the YouTube channel. It's on Spotify. It's on Apple. It's on all the podcast platforms out there where we talk about what needs to change in the market with inventory, just in general, to see some change. And we talk about things like demographics, boomers, new construction, housing, just everything, interest rates, all of these different factors, and how they're likely to impact inventory, how they're likely to impact housing. So if you haven't done so, go over to the Educated Home Buyer YouTube channel, check it out, subscribe. If you find any value, like the content, it helps out. And with that said, if you need a mortgage professional here in California on the East Coast, you can get in touch with Josh. There'll be a link scrolling in just a minute. And if you need to get in touch with me, myself, you can go to that same link, and I would love the opportunity to help you here locally. I've actually got a couple new listings. So if you're local and you are looking for something that's not on the market, got a 2-bedroom, 2-bath coming up in Long Beach tomorrow, the next day. I'll plug that on here. Cute little property off Ocean, on the east side of Ocean. Got a property in Lakewood coming to the market. It's coming soon right now. Super cute property, 3-bedroom, 2-bath. Just over 1,600 square feet, really dialed in. Really nice property. Everything has been redone in it, and it's listed at 809. So both really good values for what they are. So if you need help, reach out. Would love the opportunity. Josh, I never plugged properties on here, but I thought it was a good time.
It was a good time, and we can tease the ultimate tease. Jeb and I have a 50-50 shot at our first investment. So over the next coming weeks, we'll let you know if it comes together, and then we'll make some fun videos and some updates on the progress of taking a home from not so pretty to beautiful.
Yeah. And if it doesn't work out, we'll tell you why it doesn't work out too. We'll make some videos out of the content regardless, because there's good stories in some of this stuff, and it can help you as a buyer. It can help you if you're looking to invest in real estate and just different things. So I think it's all good stuff. Right. Mr. Josh, what do we got here? Do we have any actual comments? We got a new member, Michael Davis. Michael, thanks for becoming a member of the channel. I appreciate that. Wanted to mention that. Let's just go with some easy stuff to start, Josh. FHA rates. Kim's asking about FHA. What I found really valuable at one point in here, and I see this stuff all the time, but I think for the viewer perspective, is when you took the snapshot of rates from Mortgage News Daily or wherever and posted it in the slides, because it gives people an idea. So let's remember that going forward. But where are we seeing rates today, Josh?
So that, just to give you an idea, I have a client in Idaho right now in Coeur d'Alene. They just got an offer accepted. They were talking to a local lender up there. That lender had them at 6.625, paying a point for it. Is that a terrible rate? No, it's not a terrible rate. For their qualifications, we're getting them 6.25 and not paying the point there. We're making good money on that one. So you can actually, if you want to pay that point and you have good credit scores above 680, that FHA can get down into the fives with paying a little bit for it. So a big range. And the funny thing, in talking to those clients today, I'd been talking to the wife. Husband's been super busy, working a lot of overtime. Finally got a 3-way call with them today, and he asked, how? Why is that? Why are you so much lower? Government loans are especially easy to overpay on. For whatever reason, direct lenders, banks love marking up their government loans, FHA, VA, and use that to subsidize their conventional rates. So on the broker side, for a million different reasons, I think brokers are better, not always better. We've gone through that before, but
Josh's internet connection leaves a lot to the imagination.
What I can say on the FHA and the government, it is almost always going to see.
Josh, we need to punch Verizon in the face. The internet connection is awful. I don't know why it goes out multiple times. We upgraded the internet connection, and we have more problems now than we did prior to having a shittier internet connection. Yeah. Answer me that. If you work for Verizon, not Verizon. It used to be Verizon. Now it's Frontier. Frontier. If you work for Frontier, call us, because we need to have you fix this. But if we go out, sorry guys, it's not us, it's you.
We're gonna have to make the tech sit here in the office with us, because it'll be great for 2 or 3 hours, and then in 20 minutes it'll go out for 10 seconds at a time, 3 times.
No, good stuff. Okay, BK says, how much is the house in Long Beach? It's not a house, 2-bedroom, 2-bath condo, listed $549,900, second floor, off Ocean. One subterranean spot. I'll have pictures tomorrow, so if you need pictures, reach out. Okay. We got that, Josh. Backrack says the Fed successfully froze the markets this year. Powell said home price correction still has a way to go. I didn't hear that comment directly, but what I did hear him say, which I was completely dumbfounded on, was somebody asked the question about the housing market and inventory and stability and whatever. And he did say that that inventory is a problem because basically sellers, this isn't verbatim, but basically sellers are keeping property, you're not selling property because of their fixed rates, right? And their mortgage payments. But then he goes on to say that inventory is picking up significantly or picking up, big time or whatever it is. And I'm like, what are you talking about, dude? Inventory's not going anywhere. It's not going to go anywhere anytime soon. So the whole idea behind him thinking inventory is picking up, I'm not sure where those numbers are coming from. Clearly, he's not paying attention to, actual market statistics, and he's just, he's reading his own headlines. But nevertheless,
Jeb, it wasn't Powell himself, but another one of the voting members of the Fed said 4, 5, 6 weeks ago, we failed to account for the fact that having ultra low rates and then raising rates would lead to lock-in and people not wanting to sell their homes. So they're academics. Again, you can't say they're stupid. You can say they're very out of touch. They're incredibly intelligent people that just have zero real world experience. And I don't know what data they're looking at. You see, there's a handful of sources you can get good data from. Altos, the National Association of Realtors.
Well, I did hear him say today that they run their own data, basically, that, they are not data dependent from other people. They run their own information. So maybe that's the problem.
They have a magic home index.
Yeah. All right. So let's go with Burn It Up. Says, what impact is the bullet train coming to the high desert on the market? I've seen prices get real steep for livable homes with minor fixes needed. Used to be affordable, but it's getting crazy. So I'm not, I don't know the bullet train coming to the desert having an effect on the market. I mean, will it? Could it? Sure. But it's too hard to say at this point, right? I mean, what's the time frame? How long does this thing take? What are the stop? Like, there's so many different factors that play into it that I'm not in touch with, quite frankly. So it's too difficult for me to answer at this time. Josh, do you have any information on it?
No, but the bullet train, the train to Las Vegas, the train to the high desert, whether they're one and the same, all of these things remind me about 2-3 months ago over in Costa Mesa, the government converted an old Motel 6 into housing for the homeless. So these are all 1-bedroom studios. So like bedroom, bathroom, kitchenette. And they ended up at a price per unit. And they didn't build this from scratch. They converted an existing hotel, was $580,000 a unit. We just talked about, Jeb, you have a nice 2-bedroom condo in Long Beach that you can get for $40,000 less than that. So lest anyone at home think that there are government solutions to anything we're dealing with, the answer is just no.
All right, good. Take this minute to ask a favor. If you find any value in the videos that we're doing, the time we're spending here, hit that thumbs up. Again, helps the algorithm, helps show us support, right? And keeps us kind of moving along. When we see the same thing every single week, you kind of get burnt out, right? But when we see growth and you guys interested in the content, it kind of gives us a reason to continue to push forward. So it's appreciated. All right, Josh, let's go with Willing. Got a couple questions around VA and some different stuff, but it says, if you have a self-employed borrower, but they haven't filed their 2022 tax returns, but plans to when they file their 2023, would you advise to wait on applying until this is completed or go with the 21 and 2020?
So as long as they filed their extension, they're still within their filing period. You are absolutely fine to go ahead with it now. You can end up in having to provide a 2022 profit and loss showing what they actually made and showing that income didn't go down, and then a year-to-date profit and loss for 2023, because we're now literally 19 months past the last documented income statement with the IRS. But no reason there to wait, assuming that they qualify with 2020 and 21 and can document P&Ls for last year and this year.
All right, we're going to go with another one just from Willing real quick. Says, if you have a veteran and he has a history of working part-time jobs for the last 2 years, would you be able to use that income? 24-month average without income loan is in grave danger. Grossing up 2023 Social Security income award letter without the 2023 tax returns. Is there a way to gross it up still? So, yeah, we'll just.
I believe so. Listen, on something like this, I would confirm. I believe VA is one that will allow you to gross up without the tax returns. She, we always get confused on Willing. They've misled us through the years about their actual sex, but they are correct that conventional loans, FHA loans, you do have to show the tax returns. So we know how much to gross it up. But I believe you're okay on VA without it, but I wouldn't bet my life on it. Now, in terms of the more important question there, 2 jobs, part-time, full-time, whatever they are, you have the 2-year history of working both of them, so you are fine. You're averaging those would be your worst case scenario. If the employer said on both of them, hey, they are required to work this many hours, or they get this salary for this timeline, you could possibly get more income out of it, but you should be fine with both incomes. You will be fine using both incomes if you have the full 2-year history. And even if it was just a bit shy, once you get beyond 18 months, if the file is otherwise strong, you can make a case for it. For you veterans watching at home, if you're dealing with a lender that doesn't have extensive experience with VA loans, you need to be, because if you get an underwriter that's conservative and says no, we can always call the VA Regional Loan Center, go through it with one of their underwriters, and they are very veteran friendly. They don't want to approve a loan that's going to put you in a bad situation. But if we can make a case as for why you are a good risk and should be approved, they will support that.
All right. There's a comment here, and then I have a comment that is related to this comment. So Don and Bev say our 3 zips of our buy box has 0 properties under 2 million in the last week. 1 over. So definitely feeling another level of slowdown in listings, but maybe just a summer blip week. I don't think it's just a blip week. I think you're reaching that time of the year where things typically start to slow down in inventory. We wouldn't have normally peaked by now. We probably haven't peaked by now, but we're going to see it. Now, the comment I was going to make is, for many of you guys know, many of you don't, I have another YouTube channel I started just for Orange County. And I just filmed a video on it yesterday that'll be edited here in the next day or so that I'll put out in the next couple of days. That said, if you want to see that video or that channel, there is a link or a YouTube handle in the description of this video. You can go find that. But what I wanted to say was, one of the reports that we subscribe to does a chart in the report, and it shows the breakdown of inventory and demand based on price point. And so if you looked under $1 million, right? So anything under $1 million, I think it makes up 32% of the inventory. So almost a third of the inventory, but 49% of the demand is there, right? So you got more demand than you have in theory supply, right? Half the demand is looking at a third the inventory under $1 million. That's why super competitive. Also why you see reports of, hey, the median home price is down here in Orange County or whatever. It's because more people are buying under that median home price. But at the same time, I think it was 34%, somewhere in there, 34% of the inventory was above 2 million. But only 12% of the demand was above 2 million. So you got more supply, less demand above 2 million. Therefore, less people are buying at the higher price point, more buying at the lower end, in theory, pulling that down. But that in no way means the value of your house has gone down. In fact, we've seen and showed reports where nationwide home prices are still appreciating. So the reason I bring this up is, if you're in a certain price point and you're having trouble, it's because typically more people can afford that. And I say lower price point, it's not an insult, lower end of the price scale, right? I mean, $1 million isn't cheap, but in our market, $1 million is not the high end of the price scale. It's where the majority of buyers are looking and therefore continuing to push up prices. That said, last thing I'll mention about the other channel is that there's a lot of community videos on there. Ignore that, right? It's going to be more content related around Orange County, Huntington Beach here real soon. I'm just trying to get some of this other content out of the way. That said, I digress and move on. All right, Josh, a lot of questions about rates being 5-6% again. We've given predictions in the past. We've been wrong in the past. But I think not just us, a lot of people believe that interest rates are going to move back down. Could you see a 5% handle in the next 6 months? Could you see?
Could, yes. If I'm
likelihood. What's the likelihood? What's the likelihood of seeing 6%? That's what, 0.5% lower than today?
more than
Three-quarters
a
of
half
a percent?
percent. The conventional stuff is in the high sixes, low sevens. The
Okay.
FHA, like for whatever reason, the spreads to the FHA and the VA, FHA especially, those folks I was talking to today, their situation priced out 7.25 conventional, 6.25 FHA. That's a monster difference there between those two. But 5%. I want to put this into context. I was looking at something when I did the chart on the spreads between 10-year and the mortgage rates. As recently as February, we had got under 2.5 on those spreads. And at the same time, the 10-year had dipped. And I locked a handful of loans under 6% just as recently as February. I think we closed 3 or 4.
Yeah.
Yeah, I mean, it was just a brief window, like 7 to 10 days, and everyone we locked in there got under 6%, both FHA and conventional. So that wasn't some aberration. That was post the 7% last fall, all the way back under 6%. I want to say it's going to happen, but when you say anything with that kind of certainty, I don't have that kind of certainty. I say 2-to-1 odds that in the next 12 months, we are in the low sixes conventional, back in the high fives FHA. And I think within 24 to 36 months, we are going to be in a position where you're probably high fours, 4.875, 5% on government loans, and mid fives conventional. And that makes a world of difference. And we have a question here. Someone says, what's your solution? Lower rates and reinflate the market? I don't think that lights a match back under the market, because you have a supply-demand balance. There are people that are locked in now with 7% rates that wouldn't feel locked in. And most will, but some people will come back into the market. You'll have additional supply. It will increase demand, but you have a break on the market right now, BRAKE, in the sense of affordability. There are a limited amount of people who can afford homes at these prices. So will that number increase if rates come down? Yes, but it's not going back to like in 2020. Think about this. Homes were 40% lower in price and rates were half what they are right now. That's a monstrous difference in the amount of people who can qualify for homes. So I think rates are going down. I think it will be supportive of the market. Some slight additional volume. Jeb, going back to your chart, are we getting back to 6.2 million annual sales? No, but I think 4, 5 million, somewhere there, and 2, 3, 4% annual appreciation is what we're likely to see due to limited supply. Affordability is limited, so it puts a brake on how much home prices can go up, how many homes are going to move, but there's support in terms of we have a big wave of people coming into prime home buying age, and many of those people can afford and want to buy a home. I should have had the chart in here for our charts this week, Jeb. It was a consumer survey that it's still like 64% of Americans that don't own want to buy a home, want to become homeowners. And that's consistent with the long-term number of what percentage of American households own a home at any given time. Nothing has changed in the underlying sentiment. It's harder now than it was, but people still want that.
No, and to go back to what you said a moment ago, like one of my mentors thinks that this year is essentially going to be the low year for existing home sales, and that they'll continue to pick up from this point forward. As rates come back down a little bit, you're going to get a little bit more steam in the market. And you're going to see 4.5 million, 5 million transactions taking place over the next couple of years. And along with that, prices are going to probably continue to move sideways to up too. So not just us saying it, it's other people as well. And I realize you can watch this and go, well, Jeb, you guys just follow the same people who have the same mentality, the same mindset. And to some degree, the answer is yes, right? I mean, those are the people that we agree with, that we resonate with, but we also, Josh and I, read a lot of negative people. The problem is with the negativity and their view, they miss a lot of the key points that I think we think are important. That's keeping inventory low, that's keeping the imbalance in the market between buyers and sellers. And so until something changes with inventory and demand, you're not going to see a meaningful change in the housing market. It's really, that's it. It always comes back to supply and demand. And at the moment, I don't know what the resolution is, if there is one, to fix this. And that's scary to think. Like, I mean, yeah, I could be so jaded in thinking that nobody's ever going to let go of their 3% rate. The reality is, yes, there will be people. There will be people that refinance and cash out and do other things and take a higher rate just because they want cash and they get rid of it and they'll end up selling the property or whatever. But at the same time, I know there's a lot of people that won't do that.
And Jeb, picking up on what you were saying, I'm reading different sources. The people that I ignore are the people that disagree with us and are just dumb. You start reading what they're saying, and you're like, that is easy to dismiss. But there are some really smart people out there that are very bearish. And you want to read and go, where are they coming from? What are they seeing? Could they be right? So when I say 2-to-1 odds, the 35% chance that I'm wrong is the chance that those smart people who are bearish are correct. And there are things that keep inflation elevated. And even those people aren't saying, hey, inflation is going to be 5-6% for the foreseeable future. They're saying, hey, 2% was the old normal. New normal is 3 to 3.5%. And that changes things. It changes things in a significant way. I don't think they are right, but it is what it is. And I just wanted to follow up. So Willie Street has a follow-up here. It says, I agree this will take years, but I don't think the solution is to just lower rates to unlock the housing market. Realize here that the only way the Fed controls long-term interest rates is doing what they did during the pandemic by buying treasuries and buying mortgage-backed securities. They don't get to lower interest rates. The markets look at inflation and they say, what is my real return? The chart we showed earlier shows that real return has got compressed over the last 40 years and the market requires less and less. But inflation will dictate what interest rates are. The Fed does not set interest rates. They set short-term interest rates. They set overnight lending rates. They are reacting to inflation to fulfill that half of their dual mandate, which is price stability. They want to keep inflation low. So they're not going to lower rates. No one's going to go, hey, you know what? I think we should drop rates today. The market is reacting to what investors require as a return on top and above and beyond inflation. So inflation is the key. And that's the thing. I don't know. Jeb doesn't know. The people that we disagree with, the people that we agree with, no one knows. You're just looking at the odds of what is most likely to happen based off of what we know now. That chart that I showed, Jeb, showing real returns have still been on that downtrend for 40 years. What it tells me is what changed post-COVID. We had a massive supply shock. So things couldn't get around the world. So you had a limited amount of goods and we had massive stimulus. In addition to people being locked at home and not able to spend the money they already had to begin with. So we handed everyone a bunch of ammunition and then said, here's a limited number of targets to go after. That tells me that that was a short-term aberration. Now, does short-term mean 6 months? No, we've proven that we're a year and a half, 2 years into this. It's probably 2-3 years. But if we normalize and the real returns that the market receives over the long haul continues to decrease, then you're going to see rates go lower. Now, the thing that has changed in reaction to those supply chain shocks, in reaction to, we had 20 years of very close partnership with China of offshoring all of our manufacturing and enjoying cheap labor throughout Asia. With the battle with China, with the problems that happened during COVID, things are going to be nearshored, maybe not brought back to the United States, but much closer and closer in terms of allies. That can lead to higher inflation. So this is some of the things that the people that disagree with us, what they're saying, that maybe 2.5%, maybe 2.8%, maybe 3.2% is the new inflation.
Good. Alex has a question here. Says, I was watching One Rental at a Time, and he mentioned the idea of pulled forward demand. Do you think it's possible we could see something similar with supply, all the supply coming at once? So Josh and I, for the better part of 2 years, we're talking about demand being pulled forward because of low interest rates, right? It took people that were probably not ready to buy a house. They decided, hell, interest rates are super low. I can buy more house now than I could ever in history. I'm doing this now, so I don't miss the opportunity. So that pulled some of that demand forward. Could you have supply all come at once? Sure, you could, but I don't know where it's going to come from. I ask you that question. Where does the supply come from? Tell me. It's not going to come from new construction. We know that at this point. Not going to come from distress anytime soon, right? You got record equity in properties. You've got people sitting on super low rates, in a better financial position, right? Many of these people owned homes prior to the pandemic. They're in a better financial position because of the pandemic than they were prior to it or after it. I mean, or after it, or the people that purchased afterwards, because they were able to lower their rate, because they have equity in their property now. So could the answer could be yes. It could all come at once, but I just don't know where it comes from. Anything is possible, but it's not likely. And that's the thing, is how likely is that to happen, Josh?
I don't see pulling forward supply. What has to happen is a stimulus, a reason to do something sooner than you otherwise would. If anything, we're seeing the opposite of it. We're pushing it further down the line till they can get more certainty or a better entry point as a seller into the market. I just don't see anything happening that's going to bring sellers en masse into the market back on the same level that they have been over the long haul. And Jeb, if you'll indulge me, I want to go back down. So Willie actually follows up with a good question, good thought process here. So you don't think that the federal government printing $6 trillion in the last 3 years have anything to do with the housing market going up? Them printing money is the ammunition that we talked about, giving people more money to do things with. So 100%, it has a lot to do with the housing market going up. But a key important thing, inflation over the long haul depends on two things. It's not just the growth in money supply, which they exploded money supply, and that has already shrunk considerably. But the reason why it didn't lead to massive hyperinflation like many would have expected is the velocity of money contracted, and the velocity of money with an aging population will continue to contract. You have to look at both pieces. Everyone loves to look at money supply. Oh my God, look how giant. We've never in history seen anything like that growth in money supply. And that's 100% correct. But you also had the concurrent decrease in velocity. Velocity picked up once people got unlocked and went out and tried to spend money like crazy. It is also normalizing at a very rapid rate. And we've had a 20-year downtrend in velocity. As long as velocity is down and money supply contracts, it is going to decrease the size of the economy. Then he follows up again. These are really good questions. If you believe so, don't you think that we'll have to pay for all that stimulus at some point? 1,000 trillion million percent. But historically, the belief was that deficit spending, if you remember, this is almost cute. Like in the 80s, we had the deficit calculator. It's like a $2 trillion deficit, and people are freaking out. Oh my God, how are we going to pay this? We just went over 30 trillion, and it's on its way to 40 trillion. Well, what they've shown is what happens with that. You have to pay back that debt. You have to pay back interest. Currently, those interest rates and debt service are increasing. What does that do? It takes money away from productive purposes and therefore decreases the growth in the economy. So when you have lower money supply, lower velocity of money, lower growth, it's going to lower inflation over time. So all those things are correct, but they go back to my saying that's an aberration in the short run. A piece of that will play out that we cannot see. The wizards in the government that passed the Inflation Reduction Act to spend trillions of dollars are paradoxically going to do the exact opposite of what they lied to everyone and said they had to do during the pandemic. And that will, if you look, that spending, like it got approved last year, but it is just now starting to trickle into the economy. That is a lot of money, and it could keep inflation higher. So there are some things that are different and have changed over time, and you're asking the right questions, but it's more complex, and those are not the obvious answers that people in the media love to throw out to you.
All right. Great definition. Good stuff. Alex follows up and says, to add context, I'm thinking lower rates would bring more inventory. Basically, the people who haven't sold would now be able to. So I asked this question, Alex, how many in my career, let me ask the question first, and then I'll tell you my experience. How many people sell homes and move to an apartment or move somewhere else and don't buy another property? They decide to rent. They decide to move into their second home. They decide to live in the van down by the river, that sort of thing, right? So how many people sell and don't take on another property? Because that is the problem, is that most people don't just sell their property and go do something else. They sell, they buy. So it's a one-for-one exchange. You buy one, take one off the market. The inventory doesn't increase. In order to get more supply in sustainable numbers, is you need people, more inventory to come to the market than you have demand willing to purchase those properties. And a seller that is a buyer doesn't help you. Yes, it might help more people at the lower end become homeowners, and that's positive. But again, you need supply to build, right? And that is, so to go back to your original question, is all the supply coming to the market at once it could open more sellers coming to the market. If you see a lot of supply come to the market at once, that it contrary to what you might think, that actually unlocks more inventory in a weird way, because it takes all of those people that haven't seen the property that they've been looking for the better part of 2 years, just because inventory has been so low. Now there's more inventory, there's more options for those potential sellers to buy. Therefore, maybe now they'll put their home on the market and unlock additional inventory. But here's the thing, it all plays out the same way because they're buying something and removing it from the market. Could I be wrong? Absolutely. But
I would tend to agree with you, Jeb. And I think the important thing is here, everyone here is talking about lower rates. And I think a couple of the people here have kind of been triggered by hearing lower rates. I don't think that we're going to have 2.5% interest rates anytime in the near future. I'm saying in the further out future, absolutely is a possibility. So when we're talking about lower rates today, we're saying not 7%, 5.5%, 6%, maybe on the low end, 5%. That's the foreseeable future. That I don't believe is stimulative. Alex here, I agree with you that it will bring some supply. It's just like Jeb said, it's not going to make a huge amount. And again, it always blows my mind. Here's a comment. They cannot lower rates. Rewind the video, because I just said about 15 minutes ago,
go back to your VCR.
The Fed does not control interest rates. I know you sitting at home want to think that there's someone with their hand on a lever raising and lowering interest rates. They, whoever they are, however you like to define them, does not control interest rates. The market says we want a real return. This is what inflation is and where we foresee it to be, and this is the return that we require. As inflation recedes, rates will drop whether you like it or not, whether it pushes home prices higher or not. Just like if rates go up, if inflation remains high and inflation goes up, rates will go up. That will slow the housing market even further and will make lesser sales at lower prices as affordability is constrained. This is math. It is not hard, and it doesn't care about your emotions.
Wow, there you go. Well, here's the thing. I'd like you to be like Willie in the sense that Willie gave us a like. So if you like the comments, if you like us taking the time to address these things, even when there's, not necessarily agree with the comment, but address it and have an open mind, be like Willie and hit the thumbs up. That helps. And if you're listening on the podcast, not looking at the visual, you can rate us and review us. That helps too. Kind of helps build the support that we're looking for. So student account says, what are the demographics of buyers? How does student loans crisis reset play into this? So, the demographics of buyers is a little bit different. You can look every single month in the existing home sales. You get a breakdown of who's buying homes. And it doesn't change very much month over month. And for the better part of the last couple of years, it's been pretty consistent. So about a third of the buyers out there are first-time home buyers. Now, we don't necessarily have a breakdown of their age per se every time, but you got to understand that first-time home buyers are typically, that 33-ish type age is when a lot of buyers come to the market. But with that said, we have 40-year-olds, 50-year-olds that have been first-time home buyers, so they make up part of that as well. You have about 20% or so that are investors. Then the rest are really move-up buyers, and they make up, different pieces of the equation, second homes and buying another home, and maybe turning their property into a rental and buying something else. So the demographic is a little bit different, and it's hard to nail down. But what I will tell you is that there are still buyers in the market. Yesterday, driving to an appointment, I mentioned the property in Long Beach earlier. As I'm driving to that appointment, I said, you know what? I'm going to go on Instagram and I'm going to talk about this because it's a question I get all the time. And if you don't follow me on Instagram, you should, so you can see pictures of my family and, I don't know, different stuff than here. But nevertheless, on there, I'm talking, just out of what's coming off my head. And it's like, who is buying homes in this market? Everybody's asking that. They're a really good example of who's buying homes in this market. They are a move-up buyer in the sense that they bought a home when they were just, together, girlfriend, boyfriend, maybe fiance. Since then, they've had a kid. This was back in 2016. They've had a kid. They have a dog. They've outgrown the property in Long Beach, so they need more space. They're moving up. They're that buyer that is looking to do something different because it's the right time in their life. Are they happy about interest rates? Probably not. Are they okay with interest rates because they understand that there's a chance that they come down? Yes. They understand that, hey, they need more space. They don't really have a choice here in staying where they are. They can choose to rent and whatever, but they've made equity in that property. They're able to take that and buy the next property. That is what we talk about all the time, buying when it's the right time in your life. They're a really, really good example of that. On the flip side, who's selling property? People that have had a death, people that have had a divorce, people that are being relocated, people that are downsizing for one reason or another, no longer need the big house. The gentleman who's a client of mine who's moving to Mexico City because his now wife has a property there. He no longer needs the property here. These are the stories. These are the things that we're talking about in this market. They're people that need to do something for one reason or another. It's not the nice to do, like, hey, it'd be really nice to move down the street to a house that's 3 times the amount that I have now. No, I'm buying that house down the street because that's what I need. Hopefully that helps.
Jeb, I like the show tonight. We're going to go over here. So Jay follows up and asks a question of student account. The reason why I say I like the show tonight, it's almost like we have a conversation.
People I didn't even address that part of it.
So following up on other folks' stuff here. So it says, at student account, you think people who are struggling with their student loans are out there snatching up homes? Anyone struggling with their student loans, absolutely not buying homes. But I can tell you, unlike the 22-year-olds who just got out of journalism school that are writing articles and are calling up people and asking about student loans, I help people all day, every day with student loans. About a third of my buyers have student loans, and there's almost only 2 types. Most, maybe 50, 65% have $10,000, $20,000, up to about $40,000, maybe even $50,000 of student loans. That's the manageable stuff. Those folks, let's say at the worst of it, the mortgage guidelines will use 1% of it if it's in forbearance or the CARES Act forbearance that we're in right now. So that's about a $500 payment. It's like having a car payment. So again, if you are excessively over leveraged and have too much debt everywhere else, and we add that 500 in, it's a problem. My student loan borrowers have good jobs, not much other debt that can be accounted for. On the other end, I have people with $200,000, $300,000, $500,000 of student loan debt.
Crazy.
And absent income-based repayment plans, those people would never buy a home. And you're probably sitting there saying, well, they should never be able to buy. That's a default. At some point, they're going to have to repay that. I can tell you, many of my clients are lawyers. Some of them are doctors, and they are in a public servant loan forgiveness program. They go work at the DA's office. And after 10 years, I've had 2 clients in the last year have over $350,000 of student loans forgiven. And when they have those $350,000 student loans, they make good money. They make $120,000, $130,000, but they live in Southern California, high rents. They were having $600, $700, $800 student loan payments. And these are smart people. They manage and they account for this. So anyone who we had another follow-up here, actually Jay, a Philadelphia Eagles fan, says, I heard student loans didn't affect anything because they already accounted for them when they got their loan and their DTI. Now, I don't expect the people who had it accounted for but weren't making that payment are going to like it when that payment starts up. But we've already seen the Biden administration has a plan to make it 5% of your disposable income versus 10%. So it's going to be less than it was prior to COVID. So are there people out there who are prevented from buying a home because they are excessively indebted on top of their student loans? Yes,
sure.
But there are also a lot of people whose student loans are not an impediment to them buying a home.
Yeah, no, exactly. Just like anything else. Will it affect some? Sure. Will it affect all? Absolutely not. That's really the story of this, of everything that we talk about. We had that question earlier. Josh, do you see anything that is good stuff here? I saw a question earlier. Okay, we're just going to go with this question here. Ricardo says, bought my home in February, San Diego. The last 2 months, I get weekly texts from different numbers wanting to buy my house. How much longer will this go on for? And can I stop it? No, not really. I mean, there might be a text number. I mean, is there a call list, Josh, where you can't text it?
Do not text registry. Let's do some research and see if we can help you guys out with that one. What I will say, we talked about this a few weeks ago. Go to optoutprescreen.com and opt out so that you're not having lunatics every time you apply for a credit card, a store credit card, an auto loan, a mortgage, get 9,000 people calling and trying to sell you more stuff. It is a big trigger. But have you noticed this, Jeb? Because I can tell you, I've got 2 or 3 texts here recently. I actually got a phone call. I did not get the phone call, Jeb. My father-in-law got a phone call wanting to know if I wanted to sell an investment property in Long Beach, California. He lives in Washington. We don't have the same name. We've never lived at the same residence. My wife is not on title to that property. I'm not on title. An LLC that I own is on title. I have no idea how they traced it there. But what I will say, something has happened here recently where the skip tracing has gotten better, and these people are getting more aggressive at trying to reach out, text, phone call, letters, and ask if you want to sell your home.
What I can tell you is that public records are absolutely crazy, right? So recently got a subscription to Property Radar. Property Radar is a service that a lot of people in our industry use, real estate mortgage. If you're looking to, say, for example, I have a client that is looking for a property in a specific neighborhood. I can go pull stats up on that neighborhood, who's likely to sell. I can look at people that have, a certain mortgage when they bought their home, just all these different stats. I can look at distress sales, foreclosures, all of this, and I can basically get a list. With that list, I can typically get emails. I can get phone numbers. I can do different things with that. Dude, I went in and searched myself. The information they have on me, wife, email address, phone numbers, dude, the addresses that I've lived in. I mean, they have everything, bro, like everything. So, Big Brother's out there, guys, and watching you. I don't personally care, so it doesn't really matter, but it's like the information is out there if somebody wants it. So that said, your phone number is tied to a property that meets a criteria that somebody is searching for, and you're probably going to continue to get messages because you're on a list somewhere. So
it's probably a function of low inventory. They can't
it definitely
in MLS and
yeah.
pull it up on their computer, so they're finding new ways to reach out.
And understand most of it is marketing, right? I mean, as a real estate agent, I can be honest with you here and say most of the messages that you get, the letters in the mail, I've got a buyer for your property, most of it's garbage. It's a way to generate listings. Why? How do I know that? Because I see it. I go to seminars. I see the crap that they put out there. So understand that. But we are in a market with low inventory. So most people do have buyers that would probably be interested in some of this stuff. So, but don't just fall for the plan that, hey, listen, they got a buyer for my property. Chances are they more or less want your listing so that they can find a buyer for your property. But anyway, all right. We are 5:57 in. Josh, we talked about the podcast last week. The podcast is next week, Josh. Pretty vulnerable to some extent. Talk about mistakes we've made, mistakes I've made personally, buying homes, selling homes, doing different things. It comes out on Tuesday. Kind of, what we're seeing in the market right now, where we feel like mistakes are being made, in different phases, what people are doing. So hopefully you guys find value in that. It'll be out Tuesday on the Educated Home Buyer YouTube channel, as well as, podcast on Spotify and Apple. So check that out. Josh, 5:58. Where do you want to go with this?
A good last one here that I think you can answer very well. So Taro Weezy, I don't wonder if he's related to Yeezy. Weezy. We've got lots of people out there. New construction. They want 10,000 at signing. Can I negotiate that down, or I have to put down the 10K earnest money? I'm in Fresno County, and then follows up. And they said if the contract falls through, it's non-refundable.
Yeah, so I would pay more attention to the second part of that, right? New construction typically has different contract than us using a California residential purchase agreement. So make sure if you're buying new construction, you're reading the full document. That being said, if you're buying new construction, get an agent still. Don't just go to the builder. Find an agent and work with them. I know several in Fresno County. If you need one, reach out to me directly. That link across the bottom will get you in touch with me. I can refer you to somebody. But nevertheless, do you have to do 10K? Probably not. But what I would say is look at the builder. How many properties do they have built? Are they having trouble selling them? Are they sitting on the market? If the answer to all of that is no, little inventory, they're selling quickly, there's tons of buyers, then you got to probably do what they say to do, which is the $10,000 deposit. Now, in the case that properties are sitting and not selling or whatever else, there's probably more room to negotiate. But get somebody that can negotiate on your behalf, separate from the builder, to have that conversation, if possible, just to try to get you in a better place. So that said, again, new construction is one of those things that you got to pay attention, because they do write their own contracts and they heavily lean towards themselves, right? Because they're trying to benefit themselves, and versus, say, the California residential purchase agreement, which is kind of middle of the road, if you will. It's there to protect sellers, there to protect buyers, there to protect us as brokers and agents in the market. So it's really all encompassing, whereas the new construction is not. So that said, guys, it is 6 o'clock. We've been here for 1 hour, got 64 likes. Love to get to 100. If you guys can hit it, there's 168 people watching. Every week people ask to speak to Josh. How do you get in touch with Josh? That link at the bottom will get you in touch with Josh. He serves in the western part of the United States. So if you need a lender to help you get pre-approved, to refinance, to get a second quote, that's a good place to reach him. Secondly, if you need a real estate agent anywhere in the country, including here in Orange County, you can reach out, same link, and get in touch. I would love the opportunity to help you locally if I can. I mentioned the other YouTube channel earlier in the video. That is in the description. Last thing, Josh, I will throw it your way and let you exit us out here.
I don't have anything all that interesting. We already
give us a good quote. Give us a high place to live.
In boca cerrada, no entran moscas.
He did that last time.
Like that
I'm gonna get. So I've been listening to Jim Rohn a lot lately.
A caballo regalo, no se mire los dientes.
He doesn't talk about that. But one thing Josh and I talk about all the time is how many people are negative on here. Like, the government's after me. I'll never be able to buy a house. Whatever. It's like, and I mentioned listening to Jim Rohn. I do it every couple of years, been listening to it. And one thing that he said to me, and it stuck with me over the last couple of weeks, is change your philosophy, change your life, right? So if you have that negative, crappy philosophy that it's never going to work out, you're never going to be able to do it, then it's probably telling you the truth. On the flip side, if you believe you can, you work hard towards it, then it's probably telling you the truth. So change your philosophy, change your life.